Welcome to J.K. Michael's Knowledge Series. This is the Career Improvement Series. Today we'll focus on financial management. On our topic we center how to make the most of savings and investments. Both savings and investing have identical objectives. Both aim to help you build surplus funds for your future use. Both can be said to be comparable in many respects. Both savings and investment vehicles ensure that we keep money or financial value in financial instruments that can be drawn upon at a future date and often require the creation of specialized accounts with financial institutions. Both require strategic focus on financial objectives such as growth, debt management, and so forth to guide planning and implementation of plans. A major difference between savings and investing, however, is that in savings, the money is frequently put into a bank account or a fixed deposit. Investing is quite different and more speculative. Investing has to do with purchasing financial assets and instruments that hold potential to appreciate in value over time. This may include stock, bonds, mutual funds, real estate, gold, and so on. Would you rather invest or save? Which would be a better option for you? That's not a very easy question to answer because different people in different situations or contexts are likely to have varied needs for either savings or investment. However, the general rule seems to be that if you need to accumulate funds for a short period, say a year or less, then it's better to save. On the other hand, if you do not need to consume the money for 2 years and above, then investment should be a better option. Investment generally are more long-term driven and speculative, as we've earlier stated. Secondly, if you've accumulated funds that can take care of risk and eventualities, then you may move beyond savings into investing. We never pray for bad things to happen, but they do happen. Should they happen, you need to be able to have 3 to 6 months of reserve funds to help you cope during this period. If you do not have this safety net, you might want to work on creating it before proceeding into your investment goals. In this video, there's not much to discuss about savings, except that it requires financial commitment and fiscal discipline. Investment, on the other hand, however, as long as you have the will, the right goal, and the right tools, it is something that can be learned and achieved. It is often smart to combine savings and investment as a strategy for financial independence. Savings can work for short-term objectives and investment can work for longer-term goals. After all, don't we all have both kinds of objectives? You could opt for financial plans that include savings vehicles, and the CDS is one example of a hybrid of a savings and an investment plan. A certificate of deposit is like a savings account that ends in that periodic deposits are made over a period of time. The funds will earn interest over the principal at a stipulated time, after which the principal may be withdrawn with the interest. It's also a savings instrument that accrues interest on a single quantity of money for a certain amount of time. Unlike savings accounts, CDS require that the money is not withdrawn over the full term to avoid penalties and missed interest. Generally, CDS provides higher interest rates as a compensation for the loss of liquidity imposed upon its participants. A 401k plan is a retirement savings plan offered by many American employers that have tax advantages for the saver. So when seeking to balance savings and investments, you could look out for options such as the CDS 401k plans or the IRAS or whatever could be the requirement savings options in your locality, high yield savings account and fixed annuities, and a balanced strategic investment portfolio. But like we advised earlier, creating a strong emergency fund and retirement savings is recommended before investing in risky stock. The simple explanation for this is that stock market fluctuations run the risk of making investors lose money. If you don't have any savings and the stock market is performing poorly, you won't be able to have any money in case of necessity. If you take the investment route, it would help to understand that there are 4 kinds of investment, and each of these have their unique characteristics, risk, and benefits, and these should be evaluated by investors when considering putting together the right investment mix. First one, shares and stocks. These are perhaps the most recognized and uncomplicated investment vehicles. The purchase of shares is like purchasing part ownership of a company that is publicly listed. It also refers to investments in equities. You can choose which of the listed corporations to invest in, but of course, after a rigorous analysis of their financial information over a period of time. Shares or stocks are purchased with the hopes that they will increase in value in the coming period and thus will deliver some profit when the shares are sold. Stocks are also one of the riskiest form of investments, and if their value or prices drop, then the investor will lose money. Careful scrutiny of the prospective company's records as well as guidance from a financial expert is highly recommended when investing in stocks. Number 2, bonds. When you buy bonds, you are lending money to a business organization or a government agency. There are two main types of bonds: municipal bonds, which are offered by local governments, and corporate bonds, which are offered by companies. Which of them do you think will carry the higher risk of default? And do you think it will factor in the projected returns of the bonds as a financial instrument? However, when a bond matures, the lender or the investor receives interest payments on the money he lent. You also receive back your principal when the bond matures. Maturation of the bond means that it has been kept by the lender for the period specified in the contract. Bonds are low-risk financial instruments, hence they generally give low returns. However, purchasing bonds do not render you totally immune to the risk of default. Companies fail and governments default. However, the safest types of bonds are those offered by the government. Number 3, mutual funds. Most investors may come together to pull together funds for investing in a number of businesses. Look at it this way: Investor A, Investor B, and Investor C bring together $100,000 each, for example, to invest in various businesses. This type of investing is known as mutual funds. There are actively managed funds and also passively managed funds. In the case of passive funds, the funds look to generate returns similar to those of an index such as Sensi or Nifty or other indexes. The composition of assets in these funds are also such that they perform at a similar level, and the fund manager is not actively involved in managing the fund. Hence, the resources required to manage these funds are lesser compared to active funds. Examples of these can be index funds or ETFs. Mutual funds have access to a wide range of instruments, including derivatives, stocks, bonds, commodities, and currencies. And mutual funds are as high risk or low risk as the securities that are being traded. So it's dependent on whether the security instrument is a high risk instrument like shares or a low risk instrument like bonds. Certificates of deposits, also known as CDS. Generally, CDSs are considered very low risk investment options. It works like loaning a financial institution some money for a nominated period of time. The investor receives back his investment along with the specified amount of interest that was agreed upon when the investment tenure expires. The risks involved are very low, and so also are the returns on CDS. There are a host of other savings and investment vehicles such as futures, retirement, savings accounts or funds, commodities, options, annuities, real estate or properties, and derivatives. You could learn a lot more on our website or in our financial classes. To summarize, savings and investments have a lot of similarities. Major difference between savings and investing is that in savings, the money is frequently put into a savings bank account or a fixed deposit account. Investing is quite different and more speculative. Investing has to do with purchasing financial assets and instruments that hold the potential to appreciate in value over time, and this may include stocks, bonds, mutual funds, real estate, gold, and so on. There are many investment vehicles or opportunities for investors to choose from, some of which will be high-risk investments and others low-risk instruments. They include stocks, bonds, real estate. Before you make a decision on a particular investment type or instrument, as a novice investor, it is highly recommended that you seek professional advice. Even though it might be more expensive than attempting it on your own, it will almost certainly save you from the dangers of uninformed choices. Also, there are numerous materials and softwares that can show you how to invest smarter. For more information on financial management, and more specifically on savings and investments, please check out our website on www.jkmichaelspm.com. We have an endless stream of trainings, courses, and materials to enhance your development. And if you haven't yet subscribed to our videos, please like and subscribe by hitting the red button with subscribe down below. Now for my questions. Which of the following investment instruments do you think hold the best risk to benefits balance? Which would you consider investing in given the opportunity? Also give us reasons for your answers. Please enter your responses in the comment section and we will go through your comments and respond or offer feedback as required. Thank you for watching this video. See you in the next video.